Real estate is traditionally an illiquid asset class. It does not trade continuously. Price discovery is slow. Transactions are expensive. Capital becomes trapped behind deeds, appraisals, financing contingencies, and regulatory frictions. A REIT is the institutional response to that illiquidity problem. The public tends to describe REITs as real estate stocks. That phrase is convenient, but analytically incomplete. A REIT is not simply a different wrapper around buildings. It is a governance and tax mechanism designed to convert slow-moving assets into liquid claims. The mechanism rests on two pillars: pass-through structure and distribution rules. A REIT is effectively a bargain with the tax code. If the entity complies with a defined set of requirements that tie its income and assets to real estate, and if it distributes most of its taxable income to shareholders, it is generally structured so that income is taxed primarily at the investor level rather than at the corporate level. This is not a charitable design choice. It is a constraint system. The distribution requirement is the price of admission. It forces the firm to behave less like a typical corporation that retains earnings and compounds internally, and more like a conduit that converts property cash flows into shareholder distributions. This institutional architecture produces the first important transformation. It turns illiquid real assets into liquid securities. Instead of purchasing a building, arranging financing, and bearing concentration risk, the investor can purchase a tradable claim, often in small denominations with continuous pricing and immediate transferability. The REIT becomes a bridge between the slow world of property and the fast world of capital markets. But liquidity is not free. When an asset becomes a security, it inherits the reflexes of the market. A REIT share price will move on risk appetite, interest rate expectations, index flows, and the cost of capital, sometimes in ways that diverge from the underlying properties in the short run. The REIT, therefore, is a hybrid instrument. It owns assets that reprice slowly, but it is priced instantly. This leads us to the second-order effect of the distribution constraint. Because the REIT distributes most taxable income, it retains less cash for reinvestment by design. Growth, therefore, becomes externally financed. Expansion typically requires debt issuance, equity issuance, joint ventures, or asset recycling. In other words, a REIT is not merely a property owner. It is a continuous capital markets participant. That distinction matters because the REIT's ability to grow and even the sustainability of its dividend depends on the spread between the yields it can earn on assets and the cost at which it can raise capital. When capital is cheap and market access is open, REIT growth can be accretive. When capital is expensive or markets are closed, growth slows and leverage becomes more consequential. This is the point where most investors make a category error. They discuss REIT performance as if it is a single phenomenon. It is not. There are two fundamentally different species of REIT risk: equity REIT risk and mortgage REIT risk. Equity REITs primarily own and operate properties. Their cash flows are rooted in rents, occupancy, lease structures, tenant quality, and operating expense discipline. The economic engine is straightforward: property income, net of costs and financing, distributed through the REIT framework. But even within equity, REITs, real estate is not a unified exposure. An apartment REIT does not behave like a data center REIT. A logistics warehouse REIT does not behave like a hotel REIT. A triple net lease model does not behave like a short duration lease model that reprices annually. The analyst is not buying buildings. The analyst is buying contractual cash flow streams embedded in leases. Lease duration, escalation clauses, renewal probabilities, tenant concentration, and expense pass-through terms determine how resilient income is across inflationary environments, recessions, or local market shocks. And then there's the discount rate channel. Even when property income is stable, the market can reprice the capitalization rate it demands for those cash flows. This is why equity REITs can decline in price even when occupancy looks healthy. The cash flow may be steady, but the discount rate is not. Now compare that to mortgage REITs. Mortgage REITs do not primarily own buildings. They own mortgage loans and mortgage-related securities. Their business model is not rent collection, it is net interest margin. They attempt to monetize the spread between asset yields and funding costs, often with meaningful leverage. This creates a different risk geometry. Mortgage REIT performance is dominated by interest rate dynamics, yield curve shape, prepayment behavior, hedging effectiveness, and funding liquidity. When rates move, the market value of mortgage assets moves. When short-term funding becomes expensive or unstable, The economics can deteriorate quickly. When volatility spikes, hedges become imperfect, and book value can swing. An equity REIT is an operating business with real assets. A mortgage REIT is a financial intermediary, managing duration, leverage, and spread. So the same label REIT can describe two instruments with different causal drivers. This brings us to the core implication. REITs are tax and liquidity engineering. Your return is a function of institutional design, not real estate broadly. The distribution rule attracts income-seeking capital, but it also forces a reliance on external financing. That reliance makes the REIT sensitive to the market's pricing of its equity and debt. When a REIT trades at a premium relative to the value of its underlying assets, it can issue equity on favorable terms and grow accretively. When it trades at a discount, issuing equity becomes expensive and growth slows or becomes dilutive. That cycle is not psychological. It is institutional. The pass-through structure also shapes the tax character of distributions. Depending on jurisdiction and the investor's profile, that can influence where REITs are held, what yield means after tax, and how investors compare REITs to other dividend-paying securities. So, how should the observer analyze REITs in a way that respects the institution? Begin with 4 questions. First, what is the underlying cash flow contract? For equity REITs, that means sector exposure, lease structure, tenant quality, escalation mechanisms, and operating cost pass-throughs. For mortgage REITs, it means the composition of the mortgage portfolio, duration profile, credit exposure, and sensitivity to rate movements and prepayments. Second, what is the financing channel? How much leverage is employed? How stable is the funding base? What is the maturity profile? How quickly does debt reprice? In equity REITs, this is often a balance sheet and refinancing question. In mortgage REITs, it is often a liquidity and margin question. Third, what is the reinvestment constraint? Because high distribution is structurally required, retained earnings are limited. Growth depends on capital markets access. That means you must track the cost of capital and whether the REIT can invest at yields that exceed that cost. Fourth, what are the agency and governance frictions? Who benefits from expansion? And how are managers compensated? Do incentives prioritize asset growth, per share value, creation, or stability? Even when the properties are similar, governance architecture can change outcomes. When the observer answers these questions, the REIT ceases to be a vague category and becomes what it actually is, a formal mechanism that converts slow assets into tradable claims under a payout constraint that rewires corporate behavior. That is the institutional autopsy. The REIT is not merely real estate exposure. It is a publicly traded governance framework built around a tax bargain and a liquidity promise. And the sophisticated question is not, is real estate attractive? The sophisticated question is, what institutional design am I buying, and how does that design transmit interest rates, capital market access, and contractual cash flows into shareholder returns? This is not investment advice, and it is not tax advice. It is institutional analysis. For continued analysis of governance structures and capital architectures, subscribe.